Welcome to the Deep Dive. We're your shortcut to getting genuinely well-informed without all that information overload. Today, we are diving deep into something pretty crucial, actually. It affects all of us, consumers, investors. It's how major banks are tackling climate change, and specifically how they're doing that through their, well, massive lending and investment power. We've spent time going through the latest sustainability reports, public disclosures from some key players in Asia, DBS, OCBC, and UOB. Our mission today really is to pull out the most important pieces for you. We're looking at how transparent they are, what targets they're setting, and importantly, what they're actually doing to drive decarbonization.
That's exactly right. And what's really fascinating here, I think, is seeing how these huge financial institutions are moving beyond just talk. They seem to be embedding climate action right into their core strategies.
Right.
And it's not just about their own buildings or travel, but really about how they influence and support their clients, their whole network. So yeah, we'll explore how well they're disclosing those financed emissions, the big number, how credible their targets look, are they science-based, and the specific steps they're taking to manage climate risk and push for change.
Okay, let's unpack that first bit then, disclosure. When we talk about a bank's climate impact, it's often those financed emissions, right?
Yeah.
The Scope 3 stuff. That seems like the real elephant in the room. The emissions from all the companies and projects they fund. How transparent are these banks about those figures? They must be huge.
Well, yeah, they are, and measuring them is complex. But if we step back a bit, you see this clear move towards using globally recognized frameworks. It brings some standardization. So DBS, for instance, in their Our Path to Net Zero report, they explicitly mention adhering to standards like GRI, the Global Reporting Initiative.
Okay, yeah, familiar with that one.
And SASB, the Sustainability Accounting Standards Board. They even talk about aligning with the upcoming IFRS sustainability standards.
Which are becoming the big global baseline, aren't they?
Exactly. And OCBC similarly aligns with GRI, SASB, and also TCFD, the Task Force on Climate-Related Financial Disclosures.
Right. TCFD focuses on the financial risks.
Precisely. And UOB also points to using various reporting frameworks, so there's definitely an effort to follow the international rule books.
So they're ticking the boxes on the frameworks, but how granular do they get? Do they actually break down where these financed emissions are coming from, like which industries?
They do get quite specific, actually, which is good for transparency. DBS, for example, identified 9 priority sectors. Think power, oil and gas, automotive, aviation, steel, shipping, real estate, food and agribusiness, and chemicals.
The big emitters, basically.
Yeah, the heavy hitters. And together, they account for nearly half of their corporate loan book.
Wow.
And they even give an annual breakdown for thermal coal exposure. It shows this really significant drop from about SGD 2.7 billion in 2021 down to 1.3 billion in 2024.
That's almost halved. It's a concrete number.
It is. It shows a real shift in capital away from coal. OCBC, they note their data has a bit of a lag, which is common. Their 2024 report shows 2023 figures based on what clients report. And UOB clarifies its calculations are based on outstanding loans, not just committed lines, and their expanding scope as they integrate the Citigroup assets they acquired.
That specificity really does build trust, doesn't it? But what about sectors where getting data is just notoriously hard? I'm thinking like agriculture or maybe parts of the chemical industry, lots of small players, complex supply chains.
That's a really important point. And it touches on how reporting itself is evolving. For those sectors you mentioned, food and agribusiness and chemicals, DBS hasn't set an emissions reduction target yet, but they have set a data coverage target.
Ah, okay. So getting the data first.
Exactly. They're aiming for over 66% of their large corporate clients in those sectors to actually report their emissions and their physical output data by 2030.
I see.
It's a crucial first step. You need the data before you can set meaningful reduction targets, especially in those really complex value chains. It shows they're not just reporting the easy stuff.
Right. They're tackling the data gaps. Okay, so that's disclosure. Now, what about the targets themselves? Once they have a handle on the emissions, are they setting credible science-based targets to actually reduce them?
Yeah.
With clear timelines, sector by sector.
Yeah, moving on to targets. And again, looking broadly, all 3 banks are committing to what they call science-informed pathways, generally aiming to align with that 1.5-degree global goal. DBS has set interim 2030 targets and net zero 2050 targets for those 9 priority sectors we talked about. They use specific reference pathways from climate science bodies. OCBC presents similar targets for key sectors like steel, aviation, shipping, aligning with benchmarks like the IEA's net zero pathway for aviation or the IMO's strategy for shipping. And UOB, in their latest report, actually highlighted that their 5 main target sectors, power, auto, real estate, construction, and steel, were all performing better than their target pathways in 2023.
Oh, that sounds like good progress then, across the board.
It does sound promising, but it's not quite a perfectly smooth ride everywhere. Acknowledging the bumps is important too, right?
Definitely. So where are the challenges?
Well, DBS is quite open about it. They report that while most sectors are on track as of 2024, 2 are not on track: steel and shipping.
Okay, why those two?
For steel, they point to carbon lock-in. Basically, the region has a lot of relatively new traditional blast furnaces. Replacing that infrastructure with low-carbon alternatives isn't easy or cheap, and the tech isn't fully scaled yet.
Right, that makes sense. Big capital investments locked in.
Exactly. And for shipping, they say it's mainly due to financing specific types of vessels, shuttle tankers, which kind of skew their portfolio alignment calculations. Now, OCBC also acknowledges their shipping portfolio is above its target pathway. But interestingly, they note they have the 3rd lowest gap, the 3rd best performance among 35 banks signed up to the Poseidon Principles for Shipping Finance in 2023.
So even though they're off track, they're doing relatively well compared to peers in that specific difficult sector.
Precisely. It shows leadership even amidst the challenges. Context matters.
And digging into those really high carbon areas, coal, oil and gas, what are the commitments there? Are they genuinely phasing out or just managing the decline?
They seem to be taking quite firm stances. DBS, for instance, is committed to zero thermal coal exposure. They've stopped new financing for thermal core mines and power plants already. And crucially, they're stopping financing for existing clients who get too much revenue from thermal coal by January 2026.
So actively exiting those relationships.
Yes. OCBC was actually an early mover here. They committed to stop financing new coal plants and mines way back in 2019.
Okay.
And now they have policies to support the early phase-out of existing plants, using things like managed transition programs. UOB also stopped new project financing for upstream oil and gas after 2022 and says it aims to be out of thermal coal financing completely by 2039. So clear phase-out timelines seem to be emerging.
Okay, this is where it gets really interesting for me, the actions. Disclosures and targets are one thing, but what are they actually doing on the ground? What steps are they taking to help their clients decarbonize, and how are they changing their own lending decisions based on climate risk?
Right, the practical side. And on supporting clients, you see some really big financial commitments. That's their main lever, isn't it? Money. DBS's sustainable financing. So loans and trade finance for green projects or transitions hit SGD 89 billion by the end of 2024. That's a huge number and a big jump.
89 billion, wow.
Yeah. And they helped companies issue another SGD 38 billion in sustainable bonds. They even won an award, World's Best Bank for Sustainable Finance. OCBC has specific products like their OCBC 1.5 degree C loan, designed to incentivize clients to adopt science-based targets.
So using loan terms to encourage action.
Exactly. And UOB reported $23.1 billion in sustainable financing last year. They've also developed frameworks for things like circular economy finance or transition finance, providing clear guidelines.
It sounds like more than just throwing money at it, though.
Yeah.
Are they offering advice, hands-on help, especially for smaller businesses, SMEs, who might find this all quite daunting?
That's a key question, yeah, the capacity building piece. And yes, they are doing that too. DBS has an ESG-ready program just for SMEs, connecting them with experts and solution providers. They also engage their retail customers via a digital portal called Live Better, with tips on sustainable living.
Interesting, reaching consumers too.
And they train their own relationship managers on green finance. OCBC does extensive training for its managers, too, and leads industry groups, like one focused on green buildings in Singapore. UOB runs something called FinLab's Sustainability Innovation Program. It's already helped hundreds of SMEs with their sustainability plans.
So they're becoming almost like climate advisors for their clients in a way.
In a way, yes. They have to, really, to manage their own risk and help clients navigate the transition.
Which brings us to the internal side. How are they weaving climate risk into their own core decisions, into credit assessments, investment choices? That feels fundamental.
Absolutely crucial. This is about their own long-term resilience. DBS, for example, has embedded its group responsible financing standard right into its credit risk process. They've even trained managers specifically on spotting greenwashing risks when looking at new sustainable finance deals. That shows they're thinking critically.
That's important.
And they use their own in-house climate scenario models for those priority sectors to assess both transition risks, like policy changes hitting a company, and physical risks, like floods or heat waves impacting assets. OCBC has its responsible financing framework guiding ESG risk management in lending and clear policies on not engaging with certain high-risk activities. UOB highlights its group environmental risk management framework. They also noted that their initial climate stress tests didn't show a huge immediate financial impact, suggesting they might be managing the risks proactively so far.
Okay, one last area that's really emerging now, nature risk. Biodiversity loss, water stress. These are deeply linked to climate change, but also distinct risks. Are banks starting to factor those in as well?
Yes, this is definitely the next frontier, you could say. It's newer, and the data is even harder to come by than for climate.
I can imagine.
But they're starting. DBS acknowledges the data limits, but is working with Cambridge University's Institute for Sustainability Leadership, CISL, to understand the economic impacts of nature loss specifically in Asia. OCBC has also participated in that same CISL research, looking at dependencies in sectors like agriculture and mining. How much do these industries rely on healthy ecosystems?
That's a huge question.
Yeah.
How do you price nature?
Exactly. And UOB did what's called a double materiality assessment. They looked at both how their activities impact nature and how their business depends on nature. And based on that, they put some nature-related rules into their financing policy. For example, palm oil clients have to commit to no deforestation, no peat, no exploitation policy.
TPE?
Yes. So it shows this growing understanding that damaging nature isn't just bad environmentally, it's a direct financial risk.
Wow, what an incredibly detailed deep dive. It really feels like these major banks in Asia are, moving past just words and getting into concrete action on climate. We've seen more detailed disclosures, science-based targets being set, even if some are challenging, and real efforts to support clients, plus integrating climate and even nature risk into their core business. They're definitely grappling with some complex stuff.
They absolutely are. And I think this leaves us and you, the listener, with a really important question to ponder. As these financial institutions keep getting better at understanding and integrating environmental, social factors, using new financial tools, better risk management, how is that actually going to shape the pace and maybe the fairness of the transition in the real economy? And thinking more personally, what new opportunities or perhaps challenges might this create for you, whether you're a consumer, an investor, maybe an employee? How will you engage with this ongoing shift?
Really powerful questions to think about. Thank you so much for sharing all that insight today.
Thank you very much. It was a pleasure.